What's up, YouTube? It's Joe Catchpolia sitting on the couch making some money investing in fractional real estate online as usual. I just want to say welcome. I know there's quite a few new people on my channel today. I could tell just from looking at the analytics. I think it's probably a number of you saw me on the One Rental at a Time YouTube channel. If that's where you're coming from, I'd like to just say welcome and then tell you a little bit about how my channel might be different from what you expect from a lot of YouTube channels. I am going to do a some underwriting for a short-term rental in Joshua Tree in a minute, but first I just want to lay some groundwork because I think if you're here for pure entertainment purposes, you're not going to get it. All of my videos are me sitting on the couch looking at one of multiple websites where there is actual short-term rental or not short, just any kind of real estate deals that are fractional for sale. That I'm looking at either to, just trying to decide if it's one that I'd buy or not. You'll see it might get a little bit repetitive. What I'm trying to do is treat the channel itself kind of like it's one of my team members that I'm training. So when I train new people in my agent business to help investors find properties, they just spend a lot of time going through deals with me. We do a lot of the same stuff. I think that sometimes it can get repetitive, but there's a lot of nuance and there's things that only really come up. If you look at 100 deals, it might come up twice, and that's the time we're going to see it. And so that's one of the things that I plan to do that, and I do that. That's probably 90% of my videos. A lot of those are on Lofty right now because they have more properties available than anybody else. But then whenever I hear about new platforms, I'll do videos about those. So how do you get the most out of this channel? I think there's a couple of ways. One, if there's a particular platform that you're most interested in, you can check out the playlist. At the moment, I only have a playlist for ground floor. It's because it's the one that is the most different. That's the debt platform that I've mentioned quite a few times. It's only 4 or 5 videos that I did of that, but I think it's a relatively easier platform to get a handle on. And if you watch those, that's probably all you need to really understand it, and then of course, do your own due diligence. I will have one I'm working on for Mogul, which is another platform where they only have 9 properties at the moment, and I'll do one for Saul's Lot as well. If those names don't mean anything to you, you can look back at some of my prior videos. But they're all those 3 other or websites I've invested in all of those and on Lofty. So I think those will be helpful. Or if you see me talk about one platform, there is a search function within each channel, so you can actually go back and see other ones on that. Um, and then the other thing is just interacting, right? Like I will answer every comment that somebody makes on here. At least until if my channel ever gets too big, that's fine. But I really am looking at this as a way to meet other investors who are trying to do the same thing. I think that fractional real estate investing is going to be the future of real estate investing, and so I'm doing everything I can to promote it, but also to help people. One of the things I think that could tank it is people making poor investments on it and getting a really sour taste. I think that's happened a lot to people on Lofty, and they hate that I talk about it a lot. But it's where I'm finding some of the best deals that I make, and so I end up talking about that. But a good number of my videos that I've done have been a result of somebody either in the comments asking a question or reaching out to me on one of the investor platform discords, or even finding my email and sending that to me. And it is just you can always email me if it's real estate related questions at joseph@birdy.com, birdy.com. At least right now in January of 2025, that is an email that I check regularly. If you're watching this in the future, that might not be the case. So I really just want to get that out of the way, and then give you one example of a recent deal. And this is just going to take a minute, but this just happened, and I'm pretty excited about it. I mentioned, lots of times, buying these discounted tokens, of properties that are doing well, but are a huge discount to their real world price. This is one where I have been buying them, tokens in this one for quite a while with my average basis be, this is a duplex in Chicago, just a long-term rental. You can see there's a lot of price movement in it, and it's because every time the price dips below $22, I bought some. Today we had a big spike, and I was able to sell about a quarter of my position in it for over $30. The average right around $32 for the sales. And I say average because I did it in three batches. That's something that I think you have to do on Lofty. We'll talk about that more in the future. Um, but so that was not a ton of money, right? I sold 30 tokens. I only had 130 in here, and I sold 30 today. But so I ended up with about another close to $1,000 in cash back in my account that I'm going to have to redeploy. Um, and that would, it was probably it was about a 30% return, and I've been investing in this particular property for less than 3 months, I believe. So that's the type of profits that you can make with some of these discounted deals, but you have to pay a lot of attention to the price moves. Um, you can see. Let me zoom back into today. Oh, 7 days. What's happening here? You can see that just my purchases moved the price down quite a bit, right? It peaked, and I mean just my sales, and I made three batch sales, and it moved the price down to below $30, and then somebody bought a little, it was back up at 30. That's all I want to mention about that. I think I just was excited. It just happened right before I did this video. And I think it is a good example of just the potential for really strong returns. But you have to be in a lot of these because, you can only move $1,000 at a time in and out of them without really moving those prices. But I mean, you can do that in a day, and then the next day, somebody can buy back, and it works. But so that's really all I wanted to mention about that. So now that we have all the housekeeping stuff out of the way, I'm going to jump into this short-term rental that I mentioned. This is a relatively new listing on Lofty. I think they put it up in October. I don't know what I was doing at the time. I'm trying to hit all of their properties eventually so that at some point in time you can go on my channel and actually search and find any property that they've done. Although I haven't been great about putting the addresses in there. I'm gonna have to go back and do that in the descriptions. I did it on some, but in any case, I think it's going to be useful to have a good sense of each individual property because as those prices change, I've already on several occasions done a video like this where I did some underwriting. I've figured out that property doesn't make sense for me at X price, but then the price moves and I buy some. Or I buy it when it comes on here and the price moves and I sell it. And then it's good to remember, a price point where I should buy back in. So I'm using these. I actually go back and look at my own sometimes when I see ones pop up. And so, I'd encourage you to try to use it that way if you find that helpful. And if not, I know this channel is certainly not going to be for everybody, and I am okay with that. So let's see. This is it's a 3-bedroom, 2-bathroom home. It's in 29 Palms, California. It's right by the Joshua Tree National Park. It's a short-term rental. One of the things, so this is an area that if you watch Rob Built's channel, he has talked a lot about this. He's got a couple of tiny homes there. It's a place that just a lot of influencers talked up in the short-term rental space, and I think we'll see that it really peaked. There's just a couple of things that I want to point out. When I do these, I try not to do the full underwriting. If you, like again, that I do. I do it. I look at all the different things, and not a full due diligence, but I look at a lot of the things offline, and then just try to give you the highlights. So a couple things I want to point out. One, one of the first ones is this. I use this spot crime map a lot. Uh, One of the things that you have to realize is that not all crime is created equal. So one thing that I mentioned before, you have to look at how long it took. So every time you open this map, it's going to show a whole bunch of crimes. You have to look at how long it took to get them all. And this one is, it's more than 3 weeks worth. And so Uh, Sometimes we'll open a map and it'll all be one day, and that's an area I probably don't want to be in. I think we actually looked at one a couple of days ago that's listed on Lofty that's the case. Um, this is pretty far back, but then in addition to that, you have to click on these and actually look at it. So like this shooting was actually reports of gunshots heard. This wasn't a shooting that they, that was a verified shooting. These This was an assault, right? But then if you open it up, it says, uh, let's see. Oh no, this one was real, right? This was a battery. Not a whole lot of information on it though. But then this other one that was an assault, it was actually a threatening phone call that somebody received, right? And so you really have to, you can't just look at these and assume that they're all the same. And that's what I like about the spot crime, is it's not just giving you data that you can't really use. And so, a lot of these are things that, to me are would if this was a real gunshot, maybe I'm not buying a property right down the street from a real shooting. But okay, somebody heard something that they said was a gunshot and they called it in, and then there was no additional report. So that's one of the things I really wanted to point out about this. I know I've talked about this spot crime map before, but I think that you know, it's it it's not really clear until you use it quite a bit, and I think this was a really good example, especially in contrast with that Baltimore one that we looked at the other day. Although I'm not sure that I clicked into that gunshot that on that one, and so I might have been a little lazy when I did that video and showed because I don't remember if that was a real one or not. Because in addition to doing these for all of my videos, I'm looking on this stuff, for my day job all the time too. So sometimes the properties bleed together, so I apologize if my memory fails me on that. So that's one thing I wanted to point out on this one. Another really funny one that you wouldn't think of. So this is out in the desert, right? But this is why we check the FEMA flood maps every single time, no matter where the property is located. It's not in a flood zone, but it is way closer to being in a flood zone than I would have expected, knowing that it's right by the desert, right? It's in the desert. Like when we look at these pictures, let me see. This this is the satellite picture, right? Like this is not what I normally expect when I think of a flood zone. But it's right at the bottom of those mountains, I guess, and that must be what's causing it. I don't really know, but it is again, it's just a good reminder. I want to look at that every single time. This is a tough one. It is uh, just like always. My very first step is opening the market, looking at the population data. This is on Wikipedia. This is the county data. I looked at that. The city data was pretty lacking because of how small it is. But it did show growth, but it didn't give us a whole big string of them. It only gave us like three years. So I wanted to look at this. Very strong growth in the county. Um, I think that has to do a lot with how property values go, but for something like a short-term rental, I don't think it's the biggest driver of stays. But then I also looked at, this is the thing, I always look at the Zillow home price trends. You can see this peaked in 2022 and came downhill. This is going to be important info in a minute, so keep that in mind. Um, and then there was one other set of, oh yeah, and then also too, I looked at the Redfin. They gave us price change data, and you can see it really dropped off a cliff here in their thing. And they had one other big dip, and so you can't necessarily trust this completely. One of the things. So let's go back to the property itself. Um, when we look at the order book, this is the market cap. So this is basically the price that we're paying if you pay $50 times all the outstanding tokens, 374,000. That's really scary in light of Redfin saying it's worth 241, and it's way below their range. But then when we look at Zillow, okay, uh, it's got a little bit higher estimate, but we also can see when it last sold. And so if you remember when we were looking at that chart, how it dropped off a cliff since 2022. So right now their price is higher than what they bought it for in that year. That's a little worrisome for me from a price perspective. Although uh, when I looked at Realtor, gives it a good price, right? 320. Okay, now we're getting closer, still not there yet. Um, and then looking at homes.com, which is usually one of my favorites. And it is, again, 307 to 316, didn't quite get there. It at least has the most recent picture. Um, but we're pretty low relative to that price. And then I also looked at the appraisal that they provide. And again, if you're new here and you want to know how to find that appraisal, these are all on lofty.ai. I do have a link in the description below to all the sites that I invest in, although I don't have a link to Saul's Lot yet. I gotta put that in there. Um, and then also, please like and subscribe if you haven't already. I always forget to ask people that. But so here on here, you just click into the documents. This is how you get to um, things like the appraisals, the trailing financials if they have it. This appraised at 340, and so when we dig into this, the offering is at 374.4. How did we get there? Well, one, Lofty lets people list it for up to 5% above the appraisal, and that's what they did for the asset price, right? 357 is what did I say? 340 times 1.05. So that's how they get to this 357. But then in addition to that, this is not all closing costs. They also, I don't know why they lump it in here, but they let them add um, furnishings if it's a short-term rental. So that's part of what's lumped into these closing costs. That's why they're so high. And then that's how they get to the total price. So for me, this is a really big premium to want to pay at the 350 when this first came out. Well, it's already been bid up to 352. Now you can see earlier this year, let's look at the 90. If you go back, this is when it was listed originally in October of last year. The price has gone all the way up to $61, which, um, seems very, very high to me. But so, okay, so basically we looked at the value, right? To me, this is way too high of a premium. I would pass on this, just for that. But one other thing I wanted to point out, because, just because I'm passing on it because of the premium, I can still figure out that, okay, well, when this gets to $40 a token, say, what does that look like, right? Because I mean, it doesn't mean that there's not some price that it works. And so let's see, 74. Well, let's say I believe 320 is really the right price, right? Divided by 74.88. So really, when I get into 42 and change, this might be attractive. And really, for me, I probably want to wait till it gets to 40 if all I was concerned about was the value. Um, Unfortunately, that's not the only issue with this one, though, right? So that's um, if you look at their cap rate, it's a 2.79%, and you're like, how on earth are they getting to these high projected returns with that? Well, this has to do with the debt structure. And again, I'm sure you've heard me talk about this before if you've seen this before. But if not, what they do is the co-owner, the person who brought this property to the site, is responsible for paying the mortgage, and so and all of the cash flow from the property gets divided between all the token holders, and so they're able to pay out significantly more cash than they would um, had that mortgage not been there, and it only works because that owner's making that payment. Um, I still have on the list of things to talk about of what's in it for owners and why would they ever do that. And I think that video is taking me a while to really put together because it is sometimes hard to truly understand the motivation in a way that it's not me describing it as a Ponzi scheme. I don't think that it is, but it's often it often the math of it kind of starts to look like it because they're like they're basically paying you too high of a return so that they can sell their pieces for a certain amount. But when at the end of the day, when you realize, well, no, it's not just that they actually get this additional ability to dilute you and get this additional appreciation, then it starts to make a lot more sense. But I'm going to do a whole separate video on that. Um, just the math of it is, I'm trying to present it in a way that it makes sense, but is not too cumbersome. So that's why I know I've been promising that for about a week now, and it's not coming. Um, so sorry about that. But yeah, so that's what's creating this high yield. But again, like I don't care if I'm getting 14% today. Uh, I want to know what I'm going to get paid forever. And in the long run, can I expect to get, a 12% or a 14% yield when the property cap rate is 2.79%? No. I think the answer is clearly no. Now, one of the things is this is not fair because Lofty is always calculating this just on a monthly basis. So they look at what it did last month and they calculate this. For short-term rentals, some months that means it's going to be really high, some months it's low. They're not looking at a trailing 12 income, which I think they should be. But again, so that's why I'm always digging into these numbers a little bit more than just to look at what they say the cap rate is, right? Got to dig that up ourselves. And so the first thing I did here is go to AirDNA, trying to figure out the numbers, looking at the projected revenue, just put in the beds, baths, and number of guests. Um, and because I have I've got the upgraded account, so I actually get to see the comparables that they pull. Yeah, if you just use the free version, I don't think you get to see these a lot of the times. And one of the neat things is a lot of times the property itself comes up, and that happened here. Um, and that's taking so long to show up. That's kind of unfortunate. I want to show you this, but I don't want to sit here and wait for it to hang. That's why I usually open up all my other tabs. But we're going to skip that for now. But you can see, revenue potential. They said 35,000. Actual revenue 34.9. Uh, One thing to note is this revenue includes all fees that were collected from Airbnb or VRBO. So the cleaning fees get pumped into that number. And so, and that's before fees. And so, the actual top line revenue ends up being lower than this, depending on how you look at it, right? Like if you net out the cleaning fees. Um, but you can see it's higher. It's at least higher than this 24,000, but it's not so much higher that I think that we're going to get there. Um, so this is one that I would probably pass on, but I want to show you one more thing about it. AirDNA lets you go back 2 years in their projections, and you can see that the income on this one has just fallen off a cliff, right? Like not this particular property. This is the estimate. We're no longer looking at that individual comp. I'm just looking at the data that it's compiling in general. We can see this in a lot of different markets, but it's especially true in markets like Joshua Tree and places that got really popular during COVID and shortly thereafter, once people started traveling again. There were a lot of markets that had just a bunch of hype and people went to. So I think two things happened. I think maybe travel was down a little bit, and that I think varies quite a bit by market, but definitely competition is up a ton. There's, lots and lots of people built properties specifically to use for short-term rental in this particular market, and so it makes sense that income has gone down. And so what people have really had to do is just work harder and harder to make the same amount of money or end up actually making a little bit less. That's one of the things I wanted to point out about this one is, sorry about that, my screen recorder froze. Um, my internet connectivity is just spotty. But so what I actually want to point out was that this operator is already doing a lot to make their property stand out. I think that it's somebody who, sometimes you could buy a short-term rental like this and think, oh, well, I'm gonna do more, even though the market's declining. I'm gonna make it more attractive to guests. And I think if you look at what they're doing here, I mean, it appears to be someone who really knows what they're doing, or they've spent a lot of time studying the short-term rental space. They have the type of design that I think does really well. They, the sorts of things that just get really great pictures. Their listing's good for it. They do have a lot of the amenities that you want. This is not necessarily, the ideal hot tub. I don't even know if that's a real hot tub. I should have looked at that. But maybe it is a cold plunge pool. I don't know. They have a lot of the things. It's not as if you could come in and tweak a few things and then just do really well with this, right? Like, I mean, that's what they did when they bought it. They had a very plain looking home, and they made it like listing ready. They did, they made it look, it very much stands out, and I think that's what you have to do to have a good listing. So, that's one of the things that I like to think about. If it is already, if they're already pulling all of the income levers, and it's, they're not creating enough, revenue for me to really be excited about it. Oh, and so I know I've mentioned this a few times before, but so the rule of thumb that I'm typically looking for, I got way off track with this. Um, I think I tried to cover too much in this video, and I'm sorry. I should have done that beginning stuff separately and then not rush this as much. But so in general, when I've got this 34,000 in projected revenue, um, I want that to be somewhere close to 20% of the price that I'm paying for the property, right? So in this scenario, uh, so let's get the little calculator out and let's say 34,000 divided by 0.2. That would mean I'd only pay $170,000 for this property, right? And that kind of checks out for me when I look at this, um, and I see such a low cap rate. I mean, that's like half of what I want to see. Now, one of the things I want to point out is that is a gross revenue number, right? That I'm using, and that's part of why I want to use the 20%. But though I also, when I'm buying one that's a rule of thumb that I use when where our clients are looking for a vacant property, because we know they're going to spend some money, not necessarily on real renovations, but to spend a little bit to get it ready, and then spend a lot on furnishings and decor. And so we found that shooting for that 20% of revenue to price of the home ratio ends up working out most of the time. Of course, you have to crunch your numbers beyond that, but that's sort of a rule of thumb. And so when you're sitting here, and we're about half of where we need to be, so on this property, um, let's say I wanted to just get to the 340, which is what they say the property itself is worth. That means I'm looking for 680 or $68,000 in top line revenue to show up on AirDNA. Well, I mean, we're obviously nowhere close to that, which is it's unfortunate, but it means that this is not one, even if it wasn't a big premium to to what we're looking at as, as far as a premium over the appraised value, which it is right now. I mean, like I said, they brought it to the platform at 5% over, and then it's gone up further. Even if that weren't the case, this is one that I'd rule out just from an income perspective, because it is, that it's just no matter what you do with this property, that top line revenue, you're not going to double it, and so it's just too far off, for me to want to invest in this one. And looking at the comparables, it makes me think it's possible that that means that there's nothing in that market that would work for my criteria. And I'm okay with that, right? I mean, one of the things that we're doing is just looking at, uh, a lot of different markets. And, I know here in San Antonio, we can usually get very close to that 20%. And like I said, close. Like, I mean, if you're at 17, 18, 19%, that's usually a deal that's worth really starting to do some math on and figure out, what that furniture and decor is really going to look like, what all your expenses are. But if we're at 10%, I think we're way too far off. When interest rates were lower, we used to go all the way down to 14% sometimes. But getting much below that, wouldn't work. But where rates are today, you've got to be quite a bit higher for me to want to jump in here. And so one of the things that I think is happening on Lofty in particular, because the debt is sort of removed from the ownership structure, initially, people are just looking at this yield. And so a lot of these properties look like they make sense as investment properties, as income properties. But over time, as that debt gets paid down and you get diluted, your yield starts to approach the cap rate. And at the same time, you're losing your appreciation. Um, you're getting an unlevered appreciation because of that same dilution. So, for me, like I said, this is not one I'm going to put money in at this price point. Um, not probably not even getting there at 40. If this one were to ever drop into the 20s, I'm definitely snatching it up. Though it's one that it looks like the operator really knows what they're doing. Other than they just have a property, they're in a market that the top line revenue in the whole market has just gone down so much, and the competition has just gotten tougher. Um, I don't think that's going to drop forever. I think you'll see more and more people getting out. I'm sure it's part of the motivation for selling some of the equity on this. I think that that's one of the things that you have to be careful of when somebody's selling and they've owned the property for a while. You have to figure out, are they doing it because they're looking for new opportunities with that cash, or are they doing it because, which I think they might be, or are they doing it because, they actually need that cash because their property is not really throwing out what it is. And I don't know that that's the case here, right? But it is clearly, not a market that's as strong as it was before. And so I can see, as a owner of an asset like this, being willing to give up a certain portion of the income. And maybe the price is at a point where they really can't sell it, even though that appraised value is higher. Um, where some of the other third party sites think it's lower. Maybe they're actually stuck in it, and this is a way to unload some equity. So I don't know, and that is all speculation on my part. As always, just because I don't invest in a property, or I think I need to be at a certain price to be excited about it, it doesn't mean that's what's right for you. You want to do your own due diligence. That's on the properties and the platforms themselves. Let me just make sure I talked about everything I wanted to on this. And I think I did. I'm starting to finally take some notes before these, so I will try to ramble a little less. And yes, I apologize. This is me rambling less than normal. So like I said, this is definitely not a high entertainment channel, but one that I hope that you can get some little nuggets out of each time we look through a property. Um, if this is one that you'd buy, I'd love to hear a comment as to why. And anytime you want to have a little back and forth about the property itself, why you think I'm wrong about certain things. If there's another property on this platform or some other platform you'd like me to look at, I'm happy to do that. If you've come up with a platform that I haven't found, so I've looked at Landa, Arrived, um, Real Bricks, Brick Save, Lofty, Mogul, Soul's Lot, Ground Floor, Arc 7. And so I've got videos about all those, but I'm sure there are a lot of others out there. This is really some white space right now where there's just all these, new players all the time. I saw Mansion came and went before I had a chance to look at it. But yeah, if you know of any others, definitely let me know about them. Oh, there was one other Roots, which is actually a REIT. Um, but yeah, let me know that as well. And I think that's really it. Until next time, I'm going to keep making mistakes so that you don't have to.